Hello and a very warm welcome to Money Control. I'm Shweta, Punj. We're sorry about this entire confusion at the start of the show. We were having some connectivity issues. It's been an interesting evening. GDP data for the quarter ending July to September has come in at 5.4%. Now, this number is way below several expectations. In fact, Money Control had done a poll of 11 economists that had predicted and projected for growth to grow for India to grow at over 6.5%. There are several reasons that are being cited for slowing growth or slowing growth, especially in this quarter. Some are saying it was unseasonal rains. There was erratic rainfall. Then there was the holy month of Shraddh, in which Indians refrained from making purchases, and of course there was a new government, that had been elected, and ministers were just setting the house in order, taking on their positions, and so on. So that's probably what slowed government spending. But is that it? What does a 5.4% growth rate mean for the Indian economy? Will it get worse or will it get better? Is this an aberration? To make sense of these numbers, I have with me three economists who do this day in and day out, and we are hoping to break this down for you as simply as possible. Joining me is Mr. D.K. Srivastava, Chief Policy Advisor at EY, Ms. Gaura Sen Gupta, Chief Economist at IDFC First Bank, and Mr. Dheeraj, economist and FX strategist at ANZ Bank. Thank you so much for joining us. Mr. Srivastava, I want to begin by asking you, how are you reading into these numbers? Do they come as a shock, considering even the RBI until now have not revised their growth forecast? They have
Well, it has definitely
stood by the
come.
7.2% growth forecast.
Yes, it has definitely come as a surprise, a negative one at that, and it does signal some very policy-related issues that require attention of the government. In particular, if we examine the GDP data from the demand side, just two components of that demand, that is private final consumption expenditure and gross fixed capital in formation, that is private consumption and government investment. These two alone account for a fall between Q1 and Q2 of 0.8 percentage points and 0.7 percentage points, respectively. That is to say, a total fall of 1.5 percentage points because of these two domestic demand factors. Overall fall between Q1 and Q2 in GDP number is 5 from 6.7 to 5.4, that is 1.3 percentage points. So that is to say that more than the overall fall, these two factors actually account for a larger fall. And of these, private final consumption expenditure fall was in some sense anticipated. You had in your opening remarks also alluded to these, but it is the government, it is the gross fixed capital formation in which government as well as the private sector have a role. This is where their real concern arises. And as far as government is concerned, it is government of India's own investment expenditure, which has been the main driver of growth until several quarters now. In fact, in Q1 as well as some of the earlier quarters, the main growth driver has been domestic demand, and within domestic demand, government demand, investment demand. And that has remained negative in the first half. So whatever was budgeted, in fact, instead of making a positive contribution, the overall contribution is nearly 15% negative growth as far as government capital expenditure is concerned. For 6 months, in fact, even in first 7 months, this has not been corrected much. And therefore, our main driver of growth, main driver of engine, has not really taken off. As a result, we are looking at this situation. It has adverse signals for the year overall growth for the year, because I think even this recovery to a level of 7% or 7.2% seems beyond reach. And our own revised estimates for the year as a whole, if we do much better in Q3 and Q4, would take us at best to about 6.3% or so.
Very very what can I say, it's a very realistic assessment of what we are seeing at this point. Let me bring in Gora here. Gora, Mr. Srivastav raised some very interesting and pertinent points on the fact that the main driver of growth has remained subdued for the past 8 months. Do you see that changing, and how concerning is that for you?
So, yes, I agree that private consumption expenditure has not really picked up, and we've had this issue since last year also. Capex was the key driver of growth, which helped us last year and also in the first quarter of this year. But there's a switch in dynamics that is happening. For example, the slowdown in consumption that we are seeing in FY25 is reflecting urban consumption slowing as urban wage growth began to slow from the second half of last year itself. So, urban wage growth is a function of listed company profits. So as listed company profits slow down, so obviously the urban wage growth, the that increase will also come down, and it will percolate into urban demand. And we are seeing that. You look at passenger vehicle sales, you look at non-oil, non-gold imports, you look at company commentary. They're all indicating that the urban side of the consumption, which was much stronger last year, is beginning to slow this year. The other aspect, which also was highlighted, is the fact that the government expenditure pattern has got dislocated because of the election. So we saw a very sharp decline in capital expenditure in Q1, and this was not just at the center, it was also at the state level. For example, the center capital expenditure declined by 35% in Q1. It picked up a little bit by 10% almost in Q2. The interesting part is state governments, their capital expenditure had also declined sharply, I think maybe more than 20% in Q1. But in Q2 also, though the pace of decline in capital expenditure slowed, it's continuing to decline. So, capex, which was primarily supported by the government, especially since last year when we've had a very, very strong growth in capital expenditure both by center and state, we've seen a temporary loss of momentum because the focus shifted during the election period, both at the center and the state level. The expectation is the second half will be a story of government expenditure coming back. Also, the second half should be a story of rural consumption coming back. Urban is expected to stay a bit muted because corporate profit growth is expected to stay a little moderate this year. Because last year, a large part of the bumper growth in profits that you saw was actually because input cost had come down sharply. This year, we don't have that sort of support from input cost side. So we still expect, yes, first half growth has been a disappointment. We were at a 6.2 for Q2. We do expect the growth momentum to pick up in the second half, led by rural as well as government expenditure, which has picked up pace post
Okay.
in Q3.
Okay. All right. Dheeraj, your thoughts on the numbers. How startled are you, or were you expecting growth numbers to come in at what they have come in at?
Sure. Look, interestingly, this time around, and unlike last few quarters, the range of forecasts around the median, was very small. I mean, a lot of people did not diverge in the fact that growth could slow down, but still remain 6% plus. So from that perspective, I think this number is quite a worrying number. And if you look at various components from the demand side as well as the GVA side, the components that are slowing down are also worrying from a policy perspective. So, for example, Dr. Srivastava and Gaura rightly mentioned about capex. The way I look at capex is three-part. The first is, of course, the budgetary capex, the push to infrastructure, the public push to infrastructure that we look at, and along with it is, of course, the real estate cycle in India. They together compose about 50% of total capex, and you can think the rest of as being the business capex. Now, you look at GFCF growth and construction sector growth together, you would see that construction sector growth did well. I mean, 7.7% is not a bad number, but still GFCF growth was a weak 5.5 number. And I think a lot of it has to do with business capex losing steam, losing momentum, which it was peaking possibly until the previous quarter. If you look at the RBI's bulletin, they've also echoed similar concerns that, maybe business capex is losing steam. And that, I think, is worrying from a policy perspective, because that is an interest rate sensitive sector, alongside, of course, facing demand headwinds from slowing urban consumption and slowing exports as well. So I do think, this particular policy GDP print makes case for policy support sooner rather than later. And of course, just to conclude, I am a bit negatively surprised, but I do want to say the print is bad, but not alarmingly bad.
All right. Okay. Let me bring in Mr. Srivastav here. Mr. Srivastav, so where do we go from here? Clearly there are policy lessons from this number. Do we get a sense that fiscal and monetary policy both have been very tight, and that's probably what has really, held the economy back, and which is why we are seeing a 5.4% number at a time when we could have had over 6% growth on at a conservative level.
Well, there is another dimension of these growth numbers that we need to recognize, which is what has happened to nominal GDP growth. So, apart from the fact that the real GDP growth fell to 5.4%, the nominal GDP growth for this quarter is 8%, and it was 9.7% in the first quarter. So, together, this is giving us an overall nominal GDP growth in the first half of close to 9%. If this trend in nominal and the IPT based inflation was 2.8% and in Q1 and 2.5% in Q2, if this trend continues, then what is really worrying is that we are departing from our potential GDP growth, as well as from our potential growth of tax revenues, because it is the nominal GDP growth that would determine the overall growth in central and state tax revenues, which would provide the resources for government investment, which is the main driver, and we expect that to remain the main driver of growth as far as the next several years are concerned in the medium term itself, because the global conditions remain rather subdued. Although in this quarter we recognize that it was not the external sector which was the cause of this unanticipated fall. Given that kind of scenario, I think there is a need for the policymakers to become very aggressive in terms of ensuring that the slippage from the projected growth of GOI's investment expenditure is not excessive. There is an anticipation that there is bound to be some fall from the budgeted growth number, but if that fall is contained in the remaining months, that is to say, if we are able to accelerate government investment expenditure, which goes into infrastructure, which then generates a cycle of demand, which would enable the private sector to pull up all the infrastructure related sectors at least. Manufacturing would be pushed up, mining and quarrying would be pushed up, electricity, gas, and water supply would be pushed up. These are the sectors that have been that bore the brunt of this fall. So I think the policymakers I would not say they were extremely prudent. I would say that they were unusually slow in taking off. And it is the fiscal policy which I think has primacy over monetary policy at the moment. Because the Monetary Policy Committee, although it does have a balanced view of growth and inflation and exchange rate movements,
Right.
it is largely focused on uh, inflation, and therefore it would come much later as far as the growth story is concerned. That burden has been passed on uh, to the government of India mainly, and supplemented by state governments. Now that's where the fiscal policy has to drive, and there is one main instrument, which is government expenditure, both capital expenditure and revenue expenditure. Capital expenditure has to be pushed up to the budgeted growth, and even revenue expenditure has been unduly slow, and even they will not they have not contributed to government final consumption expenditure, and therefore it is time to really be alerted, and the main action, I think, lies with the government of India.
So now we are saying the main action lies with the government of India. They have been saying that we're making it easy to do business. We've been focusing on that. They keep allocating the allocations for infrastructure. Capex keeps going up. In fact, this year they increased their devolution to the states as well. So, but there is clearly a miss somewhere. Gaura, I want you to come in on this. What is it that is not exciting the private sector to come move forward and invest, and what is holding back urban demand? And you said that you're optimistic about the rural growth story. Agriculture has shown good growth, but is that what you're basing your optimism on, or is there something more in play?
So sorry, sorry about that. So okay, so private capex. So last time India saw very strong private capex was in I think FY05 to FY08. That time we had almost more than an average growth of around 20% of uh, gross capital fixed investment in real terms on a consistent basis. That period, India's GDP growth averaged at 8%. So it was the so called golden period. And in that time, if you see the data, the pickup in investment was led by private corporate capex. They had a couple of factors that helped them. The first factor was private consumption during that period grew at 6% consistently.
Hmm.
It's a decent, stable growth. The other factor which really helped is that export growth during that period in real terms averaged 20%. So you had strong global demand. At that time, the world was growing faster. China was growing faster. We had younger demographics globally. And the other thing that helped was corporate profitability during that period. Even that was growing at a faster pace. So the demand component is really missing. So for example, you've
Hmm.
got an uncertain outlook. You listen to company commentary, they're all very consistently saying that urban consumption is weakening. They're hopeful that rural will pick up, but it's a
Yeah.
will pick up that will kick in once the harvest season comes. So basically it's a second half story. So private sector capex, they are correct to be tentative in adding fresh capacities unless they see visibility in demand. In such a scenario, the government has to continue supporting capex. So right now in the first half, we saw some, you know, change in government expenditure pattern because of the elections, both at the center as well as the state level. We are hopeful, and also you can actually see that in terms of the overall government cash surplus, which has really dropped. For example, your government cash surplus went from a peak level of 5.1 trillion in May to a temporary deficit in November. This just shows you the extent that the center has begun to spend in the second half of FY25. So the center is trying to ramp up their expenditure. It's the states which have not picked up as much. So the other leg of the story would be the center plus the states, revving up
Top.
their capital expenditure, because in
Okay.
such a demand condition, you cannot expect the corporate sector to willingly add capacities when they don't have visibility on demand.
So let me just take this argument forward. Coming to you, Dheeraj, and now Gora raises an important point about demand, right? At this point, in terms of policy priorities, now government has been focused on increased capex and infrastructure creation, but and correct me if I'm wrong, but we've not seen that, having a multiplier effect on the economy as one would have hoped. Clearly, there's something that's not worked according to plan, because we have been spending on capex. At this point, do you is there a case for the government to boost demand directly? And by that I mean, we have high interest rates, our savings rates have been down. It's nearly down to some 28% from what I remember, from 35%, say, about a decade ago. So savings rate have declined. Indians have less, they're saving less for sure. Interest rates are high, cost of capital is high. Is that something that the government needs to be focusing on at this point?
Look, I think there is no this and that in this particular equation. I would say, as far as the public's expenditures are concerned, expectations have been very broadly set that fiscal deficit at 4.9% of GDP, certain budgeted growth for revenue expenditures, and certain growth for capex. Quite encouraging when the numbers were released. I would hope that the government realizes those numbers, the central government realizes those numbers, and nothing amiss happens on the state side. I would not at this point advocate that a fiscal largesse should be the part that should be adopted to support growth. Like I said, this print is worrying, but it's not alarmingly worrying to warrant any urgent support from the fiscal side. So, like Dr. Srivastava said, I believe that if the governments end up exhausting their budgeted limits for spending by the center and the states this particular fiscal year, that would be good enough. Now, coming to the monetary policy, look, monetary policy, as far as interest rates are concerned, was not acting in isolation. So, if you look at credit growth, it has certainly peaked and now it's falling because of course, macroprudential regulations as well. And we've also seen equity markets correct. And we know that the last few years, the tailwinds, from the wealth effects of the equity markets had been strong, especially for urban consumption. So, there's a whole ecosystem in which the private demand, especially on the urban side or the richer side of the economy, was functioning, and that is where we've seen a significant slowdown. Now, can the RBI correct that entire ecosystem just by addressing interest rates? Perhaps not, but you have to also recognize that that system is operating in certain financial conditions which have certainly tightened in the recent months, if not in the recent quarters. Your exchange rate has
Sure,
depreciated, your
sure.
overnight funding rates have gone up, liquidity has been a bit dry, in the banking system. Banks have generally been starved of liquidity, so of course they're exercising caution in terms of lending as well, apart from of course the burden of the macro prudential regulations, etc. In this particular scenario, having slightly affordable policy rates, just to paraphrase the finance minister, may be a small support to the economy. But I do think it's a bit of a cyclical correction that's happening for the Indian economy, coming off a very strong base, and this is not something extraordinarily weak. I would like to reiterate.
Okay, Mr. Srivastav, do you agree with Dheeraj? This is a cyclical correction. However, I disagree with him on this. I don't think that that's the case at all. For an economy like India, 5.4% rate is not cyclical correction, according to me, but that's me. And in your decades of experience, of analyzing the Indian economy, what's your sense, Mr. Srivastav? What's your policy prescription? And I'll ask you the same question that I asked Dheeraj on, has the government, I mean, should the government be focused on, giving demand an impetus at this point? Because we have followed a very tight fiscal and monetary policy. And there is a spillover effect, right? You see wage growth that's down. You see corporate earnings, they've not been encouraging. You see rate of unemployment, it's worrying. So there are some pieces of the puzzle that need to be readjusted. That's how I am looking at it.
Yes, I think there is no doubt. I do agree that it is in some part a cyclical correction, but I think that we should understand this and appreciate this situation in the context of our overall longer term objective. In that longer term scenario, where we are headed for a Viksit Bharat, we have to maintain a potentially a growth rate in the range at least of 6.5 to 7% year after year. And in that context, we should also recognize that global growth conditions are going to remain subdued for a long time. And they would be characterized by relatively lower overall growth, but also by considerable uncertainties, in which it will be very difficult for private decision makers to really anchor their future plans. And therefore, most of the burden really falls on domestic economic stakeholders, but particularly on domestic governments, both the central government and the state governments. Now, here, the central government has had a recognition from early on that of the two kinds of expenditures that it can support, consumption expenditure and investment expenditure, it had shown a clear preference for a much higher growth in investment expenditure. And that is what helped us for the next last 3 to 4 quarters. Now, the contention that it is due to the elections that the investment expenditure had to be slowed down is true for this quarter, but it is not true in the longer term political cycle history. In fact, the various fiscal data show that in election years, government expenditures go up, including government investment expenditures. The government seek a lot of visibility in terms of being seen as building roads and expanding uh,
Right.
employment in construction and so on. So this the election related explanation does not hold good actually. And however, going forward, I think there is still time for the government to accelerate its investment expenditure on infrastructure and also take its revenue expenditure growth to close to from presently 4% further up to 6 to 7% at least, which may not be that difficult, but it is the investment expenditure which is more difficult because it requires a lot of physical planning and so on. It is somewhat inexplicable that they kind of let go of that handle. But going forward, I think we have to operate on domestic demand, on government's role, if we have to realize our Viksit Bharat dream. So this situation would be very different from what we experienced in the years just preceding 2007, 8, 9 crisis. So we
Right.
will never have that kind of golden period as far as external sector is concerned.
Right. Just a question, Mr. Srivastav. When we talk about infrastructure creation, also, shouldn't that also be an outcome of demand? What is the point of building roads and highways and, airports in small towns and villages where people don't even have access to, say, toilets? So, what I'm trying to get at is that is there a case for following an infrastructure creation policy as a fallout of wherever you see demand, or you know and use your funds accordingly, not put all your eggs
That
in
is
one
that.
basket.
Yeah, you are right. That is a locational issue. Where to place your infrastructure
Yeah.
expansion or increased activity. But
Hmm.
various studies after studies have shown that there is deficient infrastructure in India. It would help the private sector if the cost of supply of various inputs goes down with better infrastructure and so on.
Hmm.
And of course, most of the priority gets for building infrastructure in urban areas, which would help urban employment and urban demand also. I think as far as the infrastructure story goes,
Hmm.
it is a supply side argument that takes precedence over demand side argument. And if we can reduce cost of provision of supply of goods, we will be
Hmm.
better off. And various studies have indicated, various comparisons, global comparisons have also indicated that we have overall deficient infrastructure, and it is in government that has to really step in. It had a very ambitious plan in terms of a infrastructure pipeline, which was a 6 year pipeline, but we have not
Yeah.
heard as far as
So
any
the Bharat
progress.
Mala project also, we don't know what's
Yeah,
happened to
yeah.
that. It's been
But
on
there
the
is
back burner. I
no
don't think that's happening. Yeah.
data that emanates as to what is the extent of progress
Hmm.
of those plans.
Hmm. Okay, so very quickly, will you be revising your forecast for this fiscal after these numbers, Mr. Srivastav?
I would revise it downwards to about 6.4%,
6.4 from what was your earlier forecast?
6.9.
6.9. Okay. Gaura, how about you?
Earlier forecast was 6.6. It's tracking closer to around 6.4, which builds in some pickup in the second half.
Okay. Dheeraj?
Well, I was at 6.8 for a very long time, but I do think there is a downside surprise there of 20 to 30 basis points now.
Okay. So if you were to list out your number one priority for the government at this point, and the one lesson that you think that the government should be taking from these numbers, what would that be? Dheeraj, let me start with you.
Look, I said I think the government is still having to toe the path between fiscal discipline and getting the budgets exhausted. So I would say get your budgets exhausted. Don't let public spending slow down way on growth because that could confuse the market watchers as well as could send confusing policy signals as well. At this point, there is no merit in beating your fiscal deficit targets.
Okay. Gaurav?
I completely agree with that. Given the fact that demand, we're going next year might be even more challenging in terms of the external demand with likely higher global tariffs. The fact that the control over how corporate profit trajectory is next year, it'll be a factor of market dynamics. So urban demand could remain muted. In that sort of a scenario, government expenditure, especially on capex, which generates jobs and in turn supports income growth, is extremely essential. And the center is definitely is doing its part, and I'm sure as we get more of fiscal data we will see that capex expenditure at the center level has begun to pick up in the second half. The other part is to incentivize state governments, which are still slowing down, at least based on data in Q2, that their capex is still declining. And they are equal stakeholders. State and center are roughly 50-50 in overall general government capex. So both these parts of the government will need to start revving up their capex in the second half, not just the center, but also the state governments. And also,
Okay.
I think we could now the next part of the puzzle will be monetary policy, and I do agree that a 25 basis point cut from RBI is not going to boost things too much, but I think the time has come that monetary policy focus shifts from being very hawk-eyed on inflation and shifts a little bit more towards what's happening on the growth front. So we do see that policy space to ease rates have come now.
Sure. Mr. Srivastav, are we
Yes,
embracing the growth
yeah.
mindset, or are we embracing the being cautious and, just ensuring that we manage to, walk a straight line while this world around us is so tumultuous? What's your sense? And yes, your one policy prescription.
Well, the government act indicated, I mean, the CGA data has indicated that fiscal deficit is likely to come lower than what was budgeted. I would say that there is no merit in that. Let us spend whatever was our borrowing limit, which was budgeted, and make sure that we meet the capex growth targets and hope for a turnaround as far as monetary policy is concerned. But the central government should not consider that as an excuse and just consider that it is elections that actually led to a
Right.
slowing down of growth.
So we are almost out of time, but I have to ask you, the fact that unemployment allowance has made it into the manifestos of, political parties contesting elections says something. Now we're not talking about job creation. Now we're talking about doles. If you're unemployed, we'll give
Yes,
you money.
yes.
So that's a
Yeah,
clear
it is.
sign in the
It
narrative.
is, yes, it is understandable, but it is a matter of worry because once you introduce these elements into the budget, then they tend to be kind of permanent features of budgets.
Yeah,
The- and
absolutely.
therefore it will be very difficult to then rectify and get back to the fiscal discipline that has been brought into the system over a longish period of time. So we need to be very careful. But I don't think that we have slipped down that far. I think it is possible to recover quickly, and a lot of action lies within the hands of central government as well as the state governments. I agree on that point.
So, when you say quickly, we can get up quickly. How much? What's the time frame that you're giving the government before it gets too late for us to miss
Well,
this window? This is supposed to be our time.
yeah, I think
Of,
next 2 quarters would be critical.
hmm.
And within those 2 quarters, I also expect that perhaps some signal would come out from our monetary authorities. And if 25 basis points also comes in handy, then private sector investment would also start possibly picking up, and some government expenditure would also. I mean, the private final consumption expenditure would also get a boost. So I think it is within the next 2 quarters that we must show a swing in the other direction.
Okay, all right. Thank you so much, Dheeraj, Gaura, and Mr. Srivastav for joining us to put these numbers into perspective. It's so important that I think it's very important for us to discuss these numbers. GDP at 5.4%, unthinkable. No one was expecting growth numbers to come in at the levels they've come in at, especially for a country like India that is that has set an ambitious target for itself, and it's a very well poised moment for India right now. This is supposed to be India's decade. So we do hope that the next 2 quarters give us better news than what this is, and the policy makers take the pertinent policy lessons from these numbers, and then I think and I believe that I'm sure things, India could come back and grow at its potential growth rate. Thank you very much for joining us, and a big thank you for all our viewers also for tuning in. Do leave your comments in the comments section below, and do send us your thoughts and feedback. And a big thank you to our guests for taking out the
Thank
time to
you.
speak. Thank you.
Thank you very much. Thank
Thank
you.
you.